Hello everyone. Welcome to the Stock Minds web channel. Investors searching for growth stories in SaaS and logistics may find Karooooo, Nasdaq KARO intriguing. With its Q2 fiscal year 2026 earnings just released, Karooooo demonstrates not only strong top-line momentum, but also improving profitability metrics and a valuation profile that may still appeal to long-term investors. In this video, we will dive into Karooooo recent earnings, stock performance and valuation, growth potential, and the risks investors should consider. About Karooooo. Founded in 2018, Karooooo is a Singapore-based technology company that provides mobility software platforms for connected vehicles, fleet management, and logistics optimization. The company operates primarily through its flagship brand Cartrack, a leading provider of subscription-based telematics and fleet management services, and also through Karooooo Logistics, which focuses on delivery as a service and last-mile logistics solutions. Karooooo has expanded rapidly beyond its South African roots into several key markets, including Asia, Europe, and the Middle East, serving both enterprise and individual customers. Karooooo financial performance. Karooooo delivered a strong set of results in its fiscal Q2 2026, which is ended in August 2025, reflecting continued momentum in both revenue and earnings growth. The company reported revenue of $76.2 million, up 22.69% from $62.1 million in the same quarter last year. Quarterly earnings per share, EPS, also improved significantly to 45 cents, compared to 38 cents a year earlier, representing an 18.42% year-over-year increase. On a trailing 12-month TTM basis, revenue reached $283.4 million, up 15.97% from $244.4 million in the prior period, while TTM EPS rose to $1.83, up 20.39% from $1.52 a year ago. The company continues to demonstrate strong profitability and capital efficiency, supported by a gross profit margin of 69.26% and a net profit margin of 19.91%. Karooooo's return on assets stood at 20.2%, while its return on equity reached an impressive 35.15%, highlighting effective management of shareholder capital. Moreover, with a debt-to-equity ratio of just 0.21, the company maintains a conservative balance sheet and ample financial flexibility to fund future growth initiatives. Over the past 5 years, Karooooo has grown its revenue at a 22% CAGR and its net income at 29.7%. Karooooo has proven to be a consistently fast grower and is still projected to grow rapidly in the future. Karooooo Fiscal 2026 Financial Forecast. Looking ahead, analysts remain optimistic about Karooooo's trajectory. Consensus estimates project fiscal 2026 revenue of $312.7 million, representing a 25.02% increase from the estimated $250.12 million in 2025. Non-GAAP EPS for 2026 is forecasted at $1.96, an expected 13.08% rise from $1.73 in 2025. Reflecting this confidence, Wall Street analysts have issued a strong buy rating on the stock, with a price target of $59.98, implying a 32.76% potential upside from current levels. The most bullish forecast sets a high target of $65, suggesting as much as 43.9% potential upside if the company continues to deliver on its growth outlook. KARO stock price performance and valuation. At the time this video was created, the stock was trading at $45.18 per share. Karooooo's stock has increased 14.9% over the past 12 months, slightly outperforming the S&P 500, which rose 14.4% during the same period. Since its IPO in April 2021, the stock has gained 32.9%, though this performance still lags behind the S&P 500's 66.7% rise over the same time frame. Despite this relative underperformance since listing, Karooooo's steady recent gains suggest renewed market interest, driven by improving financial results and consistent growth. From a valuation standpoint, Karooooo appears reasonably priced relative to its strong fundamentals. The company currently offers a dividend yield of 2.77%, providing investors with income in addition to potential capital appreciation. Its price-to-sales (PS) ratio is 4.92 on a trailing 12-month basis, and forward PS is 4.46. The non-GAAP price-to-earnings (PE) ratio is 23.94, while the forward PE is 23.04. Based on fiscal.ai data, if we look at the valuation since 2021, the forward PS and forward PE are around the average. This indicates a fair valuation for KARO stock, but since it has been growing at a double-digit rate, the valuation still makes the stock compelling for investment. KAROOO growth potential. KAROOO growth prospect remains robust, driven by several factors. 1. Accelerating geographic expansion with untapped market penetration. KAROOO targets significant growth through geographic expansion across 3 primary regions, with South Africa as the cornerstone, contributing 71% of subscription revenue and currently at about 35% market penetration. This indicates ample room for acquiring new customers despite already having 1.9 million subscribers. Europe presents even stronger growth potential, with a 27% year-over-year subscription revenue increase and only 20 to 25% market penetration in a population of 450 million. The fastest-growing region is Southeast Asia, where subscription revenue expanded 26%, reaching less than 10% of the addressable market. To address distribution constraints, KAROOO plans to increase its Southeast Asia sales force by 70% through February 2026. Supported by new offices and enhanced distribution infrastructure, this systematic expansion is expected to accelerate subscription revenue, leveraging proven product-market fit and operational excellence, signaling strong management confidence in sustainable, profitable growth in underpenetrated markets. 2. Product innovation and cross-sell momentum driving RPU growth. KAROOO's platform supports ongoing product innovation, boosting per-customer revenue beyond just new subscriber growth. They launch proprietary video solutions and car track tag hardware, utilizing 275 billion monthly data points to offer AI-driven safety, compliance, and asset tracking features. Although video sales currently make up just 10%, management views this as a significant underexploited opportunity within their large existing customer base. In Q2 2026, average revenue per user (RPU) grew by 4% year-over-year, aligning with the company's goal to reach 10% ARPU growth in South Africa and around 6% for the whole group. The sales team deliberately focuses on cross-selling new products to current customers rather than solely acquiring new subscribers, leveraging a 95% commercial customer retention. As teams and processes mature, wider platform adoption and increased feature usage are expected to drive revenue growth beyond current subscription rates. 3. Subscription revenue model with superior unit economics. KAROOO's financial structure reflects outstanding unit economics that support ongoing profitable growth and durable competitive advantages. In Q2 2026, the company achieved a 72% subscription gross margin and maintained an LTV or CAC ratio exceeding 9 times, highlighting robust capital efficiency and scalability. The platform's value is validated by a 95% commercial customer ARR retention rate, signaling strong switching costs and predictable revenue streams. CardTrack operating profit margins held steady at 29%, demonstrating disciplined cost management despite investments in sales and product development. This combination of high margins, efficient customer acquisition, and exceptional retention fuels a compounding economic model where incremental customers generate higher profitability as fixed costs spread. Management emphasized accelerating subscription revenue growth from 15% in Q2 2025 to 20% in Q2 2026, while maintaining profitability, defying typical SaaS trade-offs. The company's Rule of 60 financial profile, combining 20% revenue growth with a 46% EBITDA margin, is exceptionally rare among public SaaS firms. Risks to consider. While KAROOO looks like a compelling investment case, we should be mindful of potential risks. 1. Margin pressure from expansion. KAROOO's rapid geographic expansion, driven primarily by strong growth in CardTrack subscribers, has resulted in increased operational expenses and margin pressure. While subscriber revenue grew significantly, sustaining profitability remains a key challenge due to the higher costs associated with scaling the business in new markets. Balancing expansion spending with maintaining healthy margins is critical for the company's long-term financial stability and growth prospects. 2. Dependence on subscriber growth. Karooooo's growth depends heavily on continuous strong subscriber additions and high customer retention, especially through Cartrack. Any slowdown in acquiring new subscribers or retaining existing customers could significantly impact revenue growth. This in turn may reduce investor confidence and put pressure on the company's financial outlook. Maintaining consistent subscriber growth and loyalty is therefore vital to sustaining revenue momentum and supporting long-term business success. 3. Competitive and operational risks in new markets. Expanding into emerging markets like Southeast Asia and Africa presents Karooooo with significant operational challenges. These include complex logistics, navigating diverse local regulations, and facing intense competitive pressures. Successfully managing these factors is crucial, as they could affect the company's ability to execute its expansion strategy efficiently and impact its financial performance. Overcoming such challenges is key to sustaining growth and achieving international scalability for Karooooo. Conclusion: Karooooo stands out as a well-managed growth company with solid financial performance, strong profitability, and an attractive valuation. The latest quarterly results highlight accelerating revenue and earnings momentum, supported by healthy margins and low debt. With a growing footprint in telematics and logistics, favorable analyst sentiment, and a reasonable forward PE, Karooooo offers both growth and income potential. Despite minor risks, its fundamentals remain strong, making the stock a compelling investment opportunity. What do you think about Karooooo? Are you buying, holding, or passing? Drop your thoughts in the comments below. If you found this video helpful, please make sure to like, subscribe, and hit the bell so you don't miss my next stock analysis. Thanks for watching and see you in the next one.